I read 100 investing books, from Warren Buffett's favorites to modern bestsellers, and here's the uncomfortable truth. Almost none of them agree on what to buy. But every single one of them agrees on something else, something that has nothing to do with stocks and everything to do with you. Today, I'm breaking down the lessons that showed up again and again across those 100 books, the ones that actually moved the needle. Stick around for the last one. It's the lesson that took me longest to actually believe. You don't need to read 100 books to invest well. You need about 7 ideas, repeated, understood, and actually applied. That's the difference between reading about investing and actually investing. Here's the rule that ties this whole video together. The books aren't selling you stock picks. The good ones are selling you behavior. Let's get into the lessons. Lesson 7, compound interest is slow, then sudden. Problem, most people quit investing early because the growth feels invisible for years. Why it matters, compound growth is exponential, not linear. Almost all the real gains happen in the last stretch, which means quitting early costs you the part that actually mattered. Real example, £10,000 invested at 8% a year grows to about £21,600 after 10 years, but grows to over £100,000 after 30 years. The first 10 years barely move, the last 10 do almost all the work. Step-by-step solution. 1. Set a minimum time horizon of at least 10 years for any core investment. 2. Automate contributions so you're not relying on motivation during the boring years. 3. Track your progress yearly, not daily, so slow growth doesn't discourage you. Common mistake, judging your strategy after 1 to 2 quiet years and assuming it's not working. Lesson 6, your behavior matters more than your strategy. Problem, people obsess over finding the perfect investment while ignoring their own decision-making patterns. 3. Automate as much as possible to remove emotion from the equation. Common mistake, believing that finding a better fund matters more than fixing your own behavior around the funds you already have. Lesson 5, risk and volatility are not the same thing. Problem, treating short-term price swings as risk and avoiding investing because of it. Why it matters, several classic investing books draw a clear line. Volatility is a price moving up and down. Real risk is the permanent loss of your money. Confusing the two causes people to avoid investments that are actually safe long-term. Real example, a globally diversified index fund might drop 20% in a bad year. That's volatility. A single company going bankrupt and your investment going to zero, that's real risk. Historically, diversified funds have recovered from volatility. Individual bankrupt companies don't recover. Step-by-step solution. 1. Diversify broadly to reduce the risk of permanent loss. 2. Expect volatility as normal, not as a warning sign to sell. 3. Reserve genuine risk concern for concentrated bets, not diversified long-term holdings. Common mistake, selling a diversified fund during a volatile dip out of fear, when the actual risk of permanent loss was low all along. Lesson 4, fees are the one variable you fully control. Problem, chasing higher returns while ignoring the fees quietly eating into them. Why it matters, you can't control the market's return. You can control what you pay to access it, and low-cost index investing is one of the most repeated lessons across nearly every modern investing book. Real example, £50,000 invested for 25 years at 7% growth with a 0.2% fee grows to roughly £256,000. The same amount with a 1.5% fee grows to only about £186,000, a difference of £70,000 purely from fees. Step-by-step solution. 1. Check the ongoing charge on every fund you hold. 2. Favor low-cost index funds over actively managed funds unless there's a clear, proven reason otherwise. 3. Review fees annually. Common mistake, assuming a fund with a higher fee must be better managed. The data across most books shows the opposite is usually true over the long run. Lesson 3. Time in the market beats timing the market. Problem, waiting for the right moment to invest or trying to predict short-term market moves. Why it matters. Missing even a handful of the market's best days can cut your long-term returns dramatically, and those best days often happen right after the scariest drops. Real example. An investor who stayed fully invested over a 20-year stretch earned significantly more than one who missed just the 10 best trading days in that same period. Step-by-step solution. 1. Use a fixed investing schedule instead of trying to pick moments. 2. Keep investing through downturns rather than pausing until things feel safe. 3. Focus on time horizon, not headlines, when deciding whether to invest. Common mistake: sitting in cash waiting for a dip and missing years of growth while waiting for a moment. Lesson 2. Your savings rate matters more than your return rate early on. Problem: obsessing over squeezing an extra 1 to 2% return while ignoring how much is actually being invested. Why it matters. Early on, how much you invest matters far more than what you invest in, simply because there's less capital for returns to compound on. Real example, someone investing £200 month at a 6% return will outsave someone investing £100 month at a 9% return for many years. The extra contribution amount outweighs the extra percentage point. Step-by-step solution. 1. Focus early efforts on increasing your savings rate. 2. Automate an increase to your contribution every time your income rises. 3. Revisit your return strategy later. Common mistake: taking on unnecessary risk chasing higher returns, when simply investing more consistently would have a bigger impact. Lesson 1. Most people don't need to pick stocks at all. Problem: believing that real investors pick individual stocks and that index investing is somehow the beginner's option. Why it matters. This is the lesson that took me longest to actually believe. Multiple respected investors have publicly recommended that most everyday investors are better off in low-cost index funds. Real example. Studies show that the majority of actively managed funds, run by full-time professionals, underperform simple index funds over 10+ year periods after fees. Step-by-step solution. 1. Use a low-cost, diversified index fund as your core holding. 2. If you want to pick individual stocks, do it with a small, clearly separated portion of your portfolio. 3. Judge your stock picking against the index fund honestly. Common mistake: feeling like index investing is boring, when data suggests it's exactly what most professionals recommend. Here's how to actually apply 100 books worth of lessons starting today. 1. Automate your contributions. 2. Check your fees on every current holding and switch to lower-cost options. 3. Increase your savings rate before worrying about squeezing extra return. 4. Default to a diversified index fund. 5. Write down your plan now so you have something calm to return to. You don't need 100 books. You need these ideas applied consistently for a long time. That's genuinely the whole game. If this helped, subscribe for more real talk money breakdowns and tell me in the comments which investing book changed how you think about money.